At exactly midnight in Frankfurt, something happened that no headline will tell you about. No press release, no market sell-off, no breaking news alert. But behind closed doors, the CEOs of Europe's largest banks were in an unscheduled emergency meeting. The agenda? Survival. This wasn't about cyber attacks, not geopolitics, not even inflation. It was about something far more fundamental. The plumbing of the financial system had just seized up. At 11:47 p.m. Central European Time, 17 major European banks activated emergency liquidity protocols, not because they were hacked, but because the repo market froze. Now, I know what you're thinking. Repo market? That's banker jargon. How does that affect me? Let me be clear. This is the oxygen that keeps banks breathing overnight. And Tuesday night, that oxygen vanished. Every day, banks borrow cash using government bonds, German bunds, French OATs, Italian BTTs, as collateral, safe, routine, automatic. For decades, it just worked, until it didn't. On Tuesday, banks couldn't get overnight funding, not because they lacked collateral, but because no one wanted to accept it. Even German bonds, the gold standard of European debt, were being turned down. Why? Not because Germany might default, but because lenders feared the borrowing bank itself might not survive long enough to return the collateral. That's not a liquidity problem. That's a trust collapse. And here's where reality diverges from the official story. Publicly, the ECB insists everything is stable. Bank stocks are calm, depositors aren't lining up. But quietly, 3 weeks earlier, something else began. Europe's pension funds started selling sovereign debt. Not hedge funds, not speculators. Pension managers, the most conservative stewards of capital on the planet. They'd run the numbers. They remembered 2022, when UK pension funds nearly imploded as bond prices crashed. So they acted early, quietly, systematically. But every seller needs a buyer. And in Europe's fragile ecosystem, the buyers are the banks. Already bloated with government bonds from years of ECB quantitative easing. So banks responded by tightening lending, higher repo rates, stricter collateral rules, shorter terms, which made other banks more desperate for cash, which made lenders even more suspicious. A feedback loop of distrust spiraled until, on Tuesday night, the market simply stopped functioning. By 10 p.m., ECB monitors saw repo volumes drop 73%. Emergency calls went out, not to regulators, but directly to risk desks at Deutsche Bank, BNP Paribas, UniCredit. By midnight, Europe's banking elite were confronting a crisis that officially doesn't exist, because modern financial crises don't start with bank runs. They start with silent freezes. Markets that won't trade, spreadsheets flashing red, systems failing without warning. The Frankfurt meeting wasn't about fixing the problem, it was about buying time. To triage which banks are truly distressed, contain contagion, and avoid public panic. But here's the critical difference from 2008. Back then, government bonds were the safe haven. Today, they're the epicenter of the storm. When even risk-free assets can't be used as collateral, hark, there is no safe harbor, no flight to quality, no backstop that restores confidence, and that leaves the ECB trapped in an impossible dilemma. Raise rates. To defend the euro and bond markets, crush over-leveraged banks, cut rates and print more, accelerate inflation and destroy faith in the currency. So they've chosen a third path, stealth intervention. More repo operations without calling it a crisis. More bond buying without admitting the market is broken. Relaxed liquidity rules disguised as temporary adjustments. Sound familiar? It's the same playbook from 2012. But this isn't a fiscal crisis. It's a monetary one, born from 15 years of ultra-low rates and endless QE that inflated every asset class beyond economic reality. You can't solve a bubble with more bubbles. You can't restore trust by creating more of the very thing people are losing faith in. Yet that's exactly what they're doing. Because admitting the alternative would mean confessing that the entire post-2008 model is unsustainable. Meanwhile, the smart money isn't waiting. European family offices have shifted 31% more into U.S. assets out in 6 months. Private banks are quietly advising top clients to diversify out of euros. Sovereign wealth funds are trimming European sovereign exposure, not out of panic, but mathematical realism. When debt grows faster than the economy forever, it becomes unpayable. When central banks monetize that debt, the currency erodes. And when currencies erode, real wealth moves elsewhere. The Frankfurt meeting ended at 3:17 a.m. No announcement, no admission, just more hidden support propping up a system straining at the seams. This isn't the end. It's the beginning of the next phase. And when it becomes visible, when bond yields spike, bank stocks wobble, and the euro trembles, everyone will ask, how did we miss the warning signs? But the signs are here now. Frozen short-term funding, pension funds exiting quietly, central banks intervening in silence, elite capital moving offshore. If you understand how money really works, not how headlines portray it, you already see the pattern. This isn't about predicting doom. It's about recognizing fragility and positioning accordingly. Because in a world where the safe assets are no longer trusted, true safety lies in strategy, diversification, and understanding what's really happening beneath the surface. Stay sharp, stay prepared, and never mistake calm markets for a sound system. Please like the video and subscribe to the channel, Mr. Finance.